Cryptocurrency was once dismissed as a fringe idea, a digital fantasy that could never compete with real money. Now, governments are paying attention, not out of curiosity, but because they have no choice. Billions of dollars move through crypto markets daily. Banks are losing control over financial transactions, and people are questioning whether they even need traditional currencies. Some countries have embraced the shift, others have cracked down, and a few are scrambling to catch up. But no matter their stance, one thing is clear: crypto is no longer just an experiment. It's forcing the world's most powerful institutions to respond. Cryptocurrency is a form of digital money, but unlike dollars or euros, it isn't controlled by any government or central bank. It runs on decentralized networks, secured by cryptography, and relies on blockchain technology to verify transactions. That means no single entity can manipulate the system, print more money, or freeze someone's assets. This independence is exactly what makes crypto appealing to millions, but it's also why governments see it as a threat. If people stop using national currencies, governments lose a critical tool for controlling the economy. If transactions move beyond their reach, tax collection and financial oversight become much harder. And if unregulated digital assets keep growing, traditional financial systems could become less relevant. For years, regulators viewed cryptocurrency as a niche market, something that only tech enthusiasts and speculators cared about. That changed when Bitcoin's value skyrocketed, when companies started accepting crypto payments, and when entire economies began considering digital currencies as part of their financial systems. Governments could no longer afford to ignore the trend. They needed a strategy, and fast. Some saw crypto's potential and decided to integrate it into their financial models. Others viewed it as a challenge to their authority and tried to stamp it out. Either way, the era of government sitting on the sidelines was over. El Salvador made history in 2021 by becoming the first country to adopt Bitcoin as legal tender. The government argued that Bitcoin could provide financial access to millions who lacked bank accounts, making transactions easier and faster. It even invested in Bitcoin itself, betting on long-term gains. But the decision wasn't without risk. Bitcoin's volatility meant the country's finances were tied to an unpredictable market. Critics warned that this move could destabilize the economy, and global financial institutions raised concerns. Still, El Salvador had made its choice, proving that governments weren't just regulating crypto, they were starting to embrace it. Not every country took the same approach. China went in the opposite direction, banning private cryptocurrency transactions entirely. The government claimed the ban was necessary to protect financial stability, but at the same time, it introduced its own digital currency, the digital yuan. Unlike Bitcoin, the digital yuan is fully controlled by China's central bank. Every transaction is monitored, giving the government an unprecedented level of oversight. This wasn't just about banning crypto. It was about replacing it with something they could control. The United States didn't ban crypto, but it didn't ignore it either. Instead, regulators stepped up enforcement. The Securities and Exchange Commission cracked down on unregistered crypto projects, while the IRS tightened tax regulations. At the same time, discussions about a U.S. digital dollar gained traction. The Federal Reserve explored the idea of a state-backed digital currency, one that could offer the benefits of crypto without giving up control. Unlike El Salvador, the U.S. wasn't betting its economy on Bitcoin, and unlike China, it wasn't outright banning crypto. Instead, it was choosing a middle path, keeping an eye on digital assets while making sure traditional finance stayed dominant. Governments are getting involved in crypto for different reasons, but their actions share a common goal: control. Regulation protects investors from scams and prevents financial crimes, but it also ensures governments maintain influence over monetary systems. A stable market is good for the economy, but strict rules can also limit the very innovation that made crypto attractive in the first place. Some fear that government-backed digital currencies could replace decentralized alternatives, shifting power back to central banks and undoing the financial independence that crypto was meant to create. Others argue that regulation is necessary for crypto to gain mainstream acceptance, making it safer for businesses and consumers alike. The future of cryptocurrency will be shaped by how governments continue to react. If regulations are balanced, crypto could become a major part of everyday financial transactions, integrated into traditional banking systems. If restrictions become too tight, developers and investors might shift their focus to more crypto-friendly countries, leading to a fragmented global landscape. Central bank digital currencies will likely become more common, offering state-backed alternatives to decentralized coins. And as governments refine their strategies, crypto itself will continue to evolve, adapting to new rules and finding new ways to operate within or outside official systems. Crypto is no longer just an experiment. It's forcing the world's most powerful institutions to respond, whether by embracing it, regulating it, or trying to control it entirely. The financial landscape is shifting, and the decisions being made today will determine whether cryptocurrency remains a decentralized alternative or becomes something entirely different. What do you think? Should governments regulate crypto more, or should it remain independent? Share your thoughts in the comments, and don't forget to like and subscribe for more content on finance, technology, and the future of money.